So without further ado, let's start with Eric. The floor is yours.
Thank you very much, Bill. And it's a great topic, and I'm looking forward both to my brief comments, but also to doing the Q&A. Since the opening comments are pretty brief, I'm going to make three main points. The first one is that I do expect over time that the digital currency technology is unlikely to be a major roadblock. So the Boston Fed is currently doing a joint effort with MIT. MIT has a digital currency initiative, and I would say they're making very good progress. So they're coming out with a working paper relatively soon that'll provide a lot more details, and I'm not going to steal any of their thunder. But at a very high level, the core payments and settlements engine meets the likely needs for throughput and transaction speed. So that's very good news that I think the technology for the core processing is there. Now, that is not to say that that is a fully developed digital currency. There's still significant work that needs to be done on privacy, on resilience, and on security. And as those various issues are tackled, it's likely to slow both the throughput and possibly the transaction speed. And obviously, we haven't had the policy discussion in Washington yet. And depending on what bells and whistles get added from that policy discussion, that could also slow down some of the throughput. But I'm pretty confident with time and money that I think these issues can be overcome. The second point I would make is that I think the major issue for a digital currency, at least in the United States, is much more likely to be on the policy front. So ideally, there would be agreement on appropriate design features between Congress, the administration, and the Fed. But to get all three to agree in an environment where both regulated and unregulated entities are going to have very strong interests in exactly how the structure develops, I think that's going to pose a political challenge to try to get an agreement. So I think it's really important that we move the technology along. So whenever that policy discussion is done, that we have the capability to launch. But until the policy discussion has been fully developed, I think it's going to be very difficult to predict when or if digital currency will come to the United States. The third is, and certainly all the panelists know this, but for people that don't spend as much time, I would say that there are very big differences between Bitcoin, stablecoin, and digital currency. And I would highlight particularly for the purpose of a digital currency, when you think about Bitcoin, it's a relatively slow technology. The asset price is highly volatile. And so I don't think it's a particularly good solution for retail payments. It's more of an alternative asset class than it is kind of a potential retail payments mechanism. For stablecoin, as Bill's comments highlighted, currently unregulated, I would concur with Bill's assessment that that probably shouldn't continue, that I do have concerns about the unregulated nature. That's particularly true depending on which stablecoin you talk about. What assets they hold backing the so-called stablecoin vary across stablecoins. Some of them look like very risky prime money market funds. Others are much closer to a government money market fund. So I do think that there is certainly a role to think about the pandemic and the financial crisis. We had runs on money market funds, primarily the prime money market funds, and they required the Boston Fed to run facilities to, in effect, bail out the money market fund industry. So we don't want to be in a position where we have to do the same thing for stable coins. Now, just as money market funds serve as kind of a transactions account for brokerage account, so if you have a Fidelity or a Schwab account, you sell stocks, it tends to go into a money market fund. You can choose whether it's a prime or a government money market fund, but it basically is a transactions account for trading. It has a lot of attributes that are similar to what bank deposits are, but for most people, they're using it for different purposes. I think the same thing's true for stable coins, that they're much more likely to continue to be a transaction account for people that are trading in and out of various cryptocurrencies. And I think that role is going to continue. Stablecoins are designed to run on a particular blockchain. They're subject to the rules of the blockchain. And it's a completely different payment and settlement mechanism than a digital currency run by the central bank. For the digital currency, at least in the United States, I think it's less likely that we're going to be designing a digital currency for the blockchain or for a particular blockchain. Currently, the work that the Boston Fed and MIT are doing are not actually operating on a blockchain, in part because we want to have sufficient throughput and speed of transactions, that the distributed ledger is not as effective a mechanism for meeting kind of the operational needs that we think we would need. I think it's very unlikely that the digital currency would be the base transaction account for cryptocurrency trading. I think that's going to continue to be a role for stablecoin. And I would view digital currency much more as a retail payment. So it really is a substitute for cash. You can't pay for something on the internet with cash. You just can't do the delivery mechanism. So the digital currency is providing you a mechanism to, in effect, use cash, but in its digital form. It's going to be safe. It's going to be resilient. It's a payment mechanism with the finality of cash. So the settlement, when you pay for a good with cash, you make the transfer and the transfer is done. You don't worry about anything else. Digital currency ideally would work the same way. So just to sum up, I expect that all three, the Bitcoin, the stablecoin, and the digital currency over time are likely to coexist. I think they're going to serve different purposes. And I don't think a digital currency by itself will cause, for example, stablecoins to disappear. I think there'll be market segmentation about what roles each of these play. The digital currency, I think, is important because it provides a low-risk payments mechanism. So there is risk in stablecoin. There's certainly risk in Bitcoin and other cryptocurrencies. And I think we want the base digital payment system to be one that is much more resilient, much safer, so that we don't have some of the challenges that have occurred in the crypto space. I think the commercial applications more than likely are going to be built on top of the digital currency. I do view this more as an infrastructure that the central bank's providing. We provide a lot of infrastructure already to the payment system, but most of the other things are added on by various financial intermediaries. So I'll just stop there and leave any additional comments for the Q&A.